Most traders think their problem is that they need better prediction. They think they need to read every swing better, anticipate every turn earlier, and react faster than everyone else. But for a lot of traders, that is not the real problem at all. The real problem is decision overload. Too many reads, too many reactions, too many low-quality decisions inside noise. And that is exactly why structure matters. Because if your whole trading process depends on constantly interpreting every twist in the market, you are going to burn mental energy, second-guess good positions, and often get shaken out of the bigger move for no good reason. So in this lesson, we are going to break down why a structure-based trend procedure can be more useful than constant prediction, why fewer decisions can actually improve your trading, and how thinking in terms of basing structure changes the way you stay with the bigger trend. A lot of traders are addicted to interpretation. They want to read every candle, every pullback, every fakeout, every possible turning point. And that style can feel intelligent because it gives the trader the sense that they are deeply engaged with the market. But deep engagement is not the same thing as good decision-making. Sometimes the more often you interfere, the worse your trading gets. Why? Because markets do not pay you for having the most opinions. They pay you for staying aligned with the move that actually matters. The idea here is not to become more clever at forecasting every twist. The idea is to operate with a cleaner procedure that keeps you with the larger move and cuts down the number of unnecessary judgments. That is a major mindset shift. You stop asking, how do I predict every turn? You start asking, how do I stay with the trend without constantly sabotaging myself? This is where basing structure becomes important. At the core, the logic is simple. Markets advance and decline in waves. If you are trying to follow a meaningful trend, you need a way to recognize structural progress without panicking at every countermove. It gives you a market-generated reference point, not an opinion, not a prediction, not a random emotional adjustment, a structural reference point. And that matters because trend following is not just about entering the move. It is about surviving the normal corrections that happen inside the move. That is where many traders fail. They are not wrong about the trend. They are just too reactive inside the trend. The basing idea helps solve that by tying your decisions to actual wave structure and stop progression rather than constant emotional reinterpretation. This part is critical. A trader who expects a trend to move cleanly in one direction will almost always manage the trade badly. Real trends breathe. They surge, pull back, build again, and then continue. If you do not understand that, you will keep reading healthy pullbacks as failure. The logic behind basing points assumes this wave behavior is normal. That is why stops are not meant to be placed so close that every routine dip knocks you out. That is a huge teaching point for modern traders. A lot of people say they want to catch trends, but they place stops in a way that proves they do not actually understand how trends behave. If you want the big move, you have to be willing to sit through the normal corrective movement inside that move. Not recklessly, not without structure, but with enough structural tolerance that normal price behavior does not keep ejecting you. This is the deeper lesson hiding underneath the method. The method is not just about stops. It is about reducing bad decisions. Think about how many unnecessary choices traders make. Should I move my stop now? Should I take partials here? Was that dip a warning? Was that wick distribution? Should I exit and re-enter? Should I lock profit now before it pulls back? All of that sounds active and engaged, but a lot of it is just anxiety disguised as analysis. A structure-based procedure removes a big portion of that noise. Instead of renegotiating the trade every few candles, you let meaningful structure tell you when adjustment makes sense. That does not make trading effortless, but it does make trading cleaner. And that is often what traders actually need. Not more intelligence, more clarity. The market can behave in similar structural ways across different time frames. The same kind of basing logic, wave logic, and trend progression can show up on different scales, even though lower time frames usually come with more noise. This is a very important teaching point. It means the market is not completely changing personality every time you zoom in or zoom out. The core behavior often repeats. What changes is the noise level, the speed, and the emotional pressure on the trader. That is why so many traders become more unstable as they move lower in time frame. They are still looking at structure, but now the structure is crowded with more false motion, more stop pressure, and more temptation to interfere. So when you hear fractal, do not turn it into abstract theory. Translate it like a trader. The same structural principles can repeat across scales, but your execution quality tends to fall apart when the chart gets noisy and your brain starts reacting to every small fluctuation. That is why higher time frame structure can be such a powerful corrective. It slows the trader down. It reduces noise. And it makes the decision points more meaningful. A lot of traders do not just have a market problem. They have a behavior problem created by the time frame they live on. If you stare at a noisy chart all day, you will feel an urge to do something all day. That is not because the market is giving you quality opportunity nonstop. It is because the chart is generating emotional stimulus nonstop. A higher time frame structural procedure helps break that cycle. When you shift toward weekly structure or other broader framing, the market stops looking like a series of emergencies. It starts looking more like a developing campaign. And that psychological change alone can improve the quality of your decisions. This connects directly to the whole value of a basing approach. You are no longer trading every wiggle. You are managing a larger move through identifiable structural developments. That can make a huge difference for traders who are constantly being baited into overmanagement. Now let's be fair. A structure-based procedure sounds clean on paper, but it still asks a lot from the trader emotionally. Because if you use broader structural stops, you will sometimes watch open profit retrace. You will sometimes have to accept corrections without panicking. You will sometimes feel like the market is taking too much back. And you will sometimes get stopped out and then watch the move continue without you. There is no magical version of trend participation with zero discomfort. That is one of the most valuable truths in the whole lesson. Structure improves decision quality. It does not remove emotional discomfort. A trader still has to grow into that. You still have to decide what kind of trend follower you are, how much fluctuation you can tolerate, how much open profit retracement you can accept, how tightly or loosely your structure should be applied. So this is not a fantasy of effortless mechanical trading. It is a better framework for making hard decisions. For modern traders, the message is powerful. You do not always need more prediction. You often need better operating logic. If you are constantly overreading the market, constantly changing your mind, constantly interrupting good positions, then a structure-based trend procedure may help more than another layer of analysis. Not because it makes you smarter, because it makes you cleaner. And that is often the upgrade traders miss. They keep trying to upgrade intelligence when what they really need to upgrade is process. The process here is simple in spirit. Identify meaningful structure. Advance only when the market gives you a valid reason. And stop trying to control every small movement inside the larger trend. That is a very different way of trading. It is less ego-driven, less prediction-driven, less reactive. And for a lot of traders, that is exactly what makes it stronger. So what should the trader actually take from this? First, stop assuming more analysis automatically means better trading. Sometimes more analysis just means more interference. Second, understand that trends move in waves. If your method cannot survive the normal corrective wave, then you are not really trading the trend. You are trading your comfort level. Third, use structure to reduce low-quality decisions. That could be through basing logic, wave lows, progressive stop logic, or another price structure method you trust. But the principle is the same. Let the market create the decision point. Fourth, respect timeframe noise. If you are overly reactive, part of the solution may not be a better indicator. It may be better structural framing. And finally, accept the real trade-off. Cleaner trend participation usually means less prediction, fewer interventions, and more tolerance for temporary discomfort. That is the cost of staying with something meaningful. So the deeper lesson here is not just about one specific procedure. It is about the kind of trader you are becoming. If you believe every move needs your opinion, you will probably overtrade. If you believe every pullback is danger, you will probably exit too early. If you believe better trading always comes from predicting more, you may miss the real advantage of structure. But if you learn to trust meaningful market structure, let the bigger move develop, and reduce unnecessary decisions, your trading can become cleaner, calmer, and much more aligned with how trends actually behave. That is why most traders do not just need more analysis. They need better structure.